the trajectory is, what the medium-term prospects for the market are, and I think they're looking excellent. And I think, as you correctly indicated, Kim, the report today from Commonwealth Bank just illustrates the point that I'm talking about. A quarterly cash profit, I think 1.9 billion, on track for a record yearly profit figure, with one expects very good dividends as well. And the banks have been doing fantastically, up about 30-40% in the last year. Telstra, look, I think we're on track to have a very good year. I've said a little earlier on, Kim, that this year we could be up about 15% to 5,500 on the index by the end of the year, and I'll still hold to that view. Get the election out of the way, and we're on the train.
Well, that's the biggest confidence thing for the market. Is, I mean, no, we've got you know, Hef the raging bull, but
always constrained, Kim.
Simon, the looks like that CBA figure is what, that net profit's going to be at $7.5 billion, an interim or final div of a couple of bucks a share. It looks like CBA's on the march to about $75. What are you telling your clients to do with CBA? Is it just sit and hold, or are you contemplating taking some off the top?
Sure. I mean, financial services and banks, they're a bit like the new resources sector, aren't they, at these levels? Record profits coming out. And they might have a $7 billion profit at the end of the year, but at this run rate, it's closer to $8 billion, which is absolutely phenomenal for such a small country. Yields, at least, are still quite good out of the banks at the moment, but it is hard to see huge growth. I think from here you can expect reasonable growth, good dividends, gradual earnings per share growth. It's probably worth hanging on to them.
Well, Hef, do you think there's any risk in the banks? Because the point that was highlighted by CBA today, and which has been coming through loud and clear in all the other bank results, is what they're doing is they're attacking their cost base. They're driving their cost base down through technological innovation and new computer systems and that. And we always know those big IT programs, as far as banks are concerned, are fraught with danger and disaster, because invariably they cost twice as much and take three times as long. So, is there a real danger there, that this whole, I guess, program of cost cutting could get derailed?
No, I don't think so. There's nothing wrong with cost cutting either.
There's nothing wrong with cost cutting per se.
And getting productivity up. And I think the Commonwealth Bank have been a quintessential exponent of the advantages of doing an IT revamp for their bank, and they've been doing this over the last couple of years with great results. And you see it when you walk into a Commonwealth Bank branch. You've got people there who welcome you, and they've only got a few tellers there because they only need to. They're doing everything so well these days, and they're now, I think, got the highest customer satisfaction of any bank. So they're kicking goals all over the place. I don't think they've gone too far in cost cutting. I think the Commonwealth Bank have led the way as far as assimilating information technology into the way that they operate. The other banks are doing it as well. I take your point, Kim. It is a big investment, but so far the banks, or certainly the Commonwealth Bank, have done it exquisitely. And I think I'll just add this also about the banks while I'm on it. We had some housing finance figures come out yesterday, which to me indicates that the dwelling sector is now on the move, and that's got to be very positive for a bank like Commonwealth Bank and Westpac in particular, given their lion's share of the housing mortgage market.
All right, well, let's move to our first caller for the evening. Ken from Brisbane, welcome to the program.
Oh, thanks, Kim. I've got a few shares in Next DC.
Yep.
And I was wondering if you could tell me on the panel, is it likely that there could be an oversupply of data centres being built?
Good. Well, interesting question, because this telco sector has been smoking hot of late, Simon, and anything that's been related to it, like M2 or IINet or TPG, has been rocketing ahead. What are your thoughts on Next DC and the data services side of the industry generally?
I'm not completely familiar with NXT, but I do think the small telecommunications sector does have some great growth prospects in it. Companies like you mentioned, IINet, TPG, have got a lot of opportunity to cut costs. So I think there's a real growth story there. Data centres, cloud, could be a little bit frothy, but really hard to value at this time.
Your thoughts on this sector? Are you investing in the second line telcos at all, or are you sticking with Telstra?
sticking with Telstra and looking at the second line telcos. And Simon's mentioned a few of them: Amcom, MTU, iiNet, TPG, all been fantastic performers in the last year. I'd still keep looking at them. This one I haven't hasn't come across my radar screen. The graph doesn't look too bad, but I would say the other ones that I mentioned probably over the last 12 months have performed better. I don't know what the fundamentals of that one are. I'd like to know its PE, return on equity, and this sort of thing. But certainly when you look at the graph, it's been a good performer. But I would say, just looking at it, that the other ones are a bit better. So worth a look. Its recent trajectory has been very good, so it's worth a look. But as I said, those other four are the ones that I'm concentrating on.
There's another great little smaller play in the sector called MyNetPhone. So these guys are in VoIP and broadband. I think they've slipped under the radar, but they've been really good at acquisitions over the last couple of years.
Yeah. There's the chart up on the screen.
Yeah.
But I mean, how much are these something of a liquidity trap in this type of market? I mean, how much volume does something like MyNetPhone trade on a daily basis?
Not a lot, probably $50,000 a day.
Yeah.
But it is a real market. It's probably on a PE of about 12, which is well below the rest of the sector. Got a decent yield. I think it still stacks up.
Yeah, you've got to be a bit careful of those. I mean, if it's only trading 50 grand a day, I mean, if you're trying to build a decent position for a portfolio. All right, our next call is Dan from Perth. Welcome to the program, Dan.
Oh, hi guys, thanks for taking my call.
Happy to. What can we help you with?
I own some shares in Energy Action Limited. The code is EAX. I've held them for almost a year now, and I've done quite well. I'm just wondering if you guys think I should still hold on to them long term. Thank you.
Interesting question, because we did a report on this one at Kimber Capital. Greg Fraser wrote a report saying, you know, the stock's worth $3 plus. But hey, don't let me bore you with all the facts. Simon, what do you think about it? Do you know anything about it?
I think you're the better one for this one.
Okay. F?
I'm not all that keen on the energy sector, frankly, at the moment. I think oil and gas are not the way to go. I haven't seen the fundamentals on this one. It's flatlined in recent times, but you would know the fundamentals of it, Kim, and they are...
Well, very... Let me take the hat from you and put it on myself. Very simply, it's in energy, electricity contracts. So it's bundling together companies that have electricity needs and then going and finding the supplier and then putting the contracts in place.
So it's making profits.
It's making profits, making very handsome profits. Floated at $1 about 18 months, 2 years ago, trading at $3 now.
Oh well, you can't beat that.
No,
well, I suppose you can, but it's not a bad effort.
And it's going higher.
Okay.
All right, it's time for a quick break. Before that, though, it's time to start the stock watch. And Simon, what are you watching? And your time starts right now.
Okay, right now we're watching stock code MNY. That's Money 3. Now these guys could be the next cash converters. They're in the microfinance business, small unsecured loans, car finance, and also car rentals. They have about 33 stores right now in Victoria, mostly, and they're starting to grow into New South Wales and Queensland. As they roll out their store network, we think there's a lot of potential for profits and share prices to rise. So we rate these guys as a buy.
Welcome back to the program. If you just joined us, Simon's Stockwatch was Money 3. Simon, what's the PE multiple on this thing at the moment?
So at the moment it's about 12.
Yep.
Compare that to cash converters, which is probably the closest peer. They're on a P of 14, but much less growth potential in that one.
And how strong is it, like the balance sheet?
I think the balance sheet in these guys is sound, but I think the real risk, if you want to say what's the risk, for things like car loans, they have to get their money from banks, and the GFC banks pulled their financing for this very quickly. So that would be their Achilles heel.
Okay. All right, and major shareholders in it, who are the executives?
Yeah, the executives.
Always a good sign. Okay. And what have you got as a price target on the stock?
I think this is something, as it is right now, you could probably make another 20-odd%, but so in a year's time, I wouldn't be surprised if it can double from here, because it just has really good earnings potential.
And we've just got the chart back up on the screen. So you've got a target of what, $1.60 on it, have you?
At least.
At least.
Yeah.
Okay. All right. Interesting. We'll put that one on the watch list and see where we are in 12 months' time in that. Our next call is Kevin from Brisbane, I should say. So welcome to the program, Kevin.
Thank you. Thank you for taking my call. I was wondering if the panel could give me their idea on ResMed, please.
ResMed. Okay. Well, this is an interesting one, because all of these stocks that have got US facing earnings have all been in great demand from the market over the past week, as we've been seeing that issue of the Australian dollar and the US dollar exchange rate intensify. So what are your thoughts on ResMed, Hef?
Yes, ResMed has been a favourite of mine many years ago. Went off the favourite list for a while, but now it's come back on it with great gusto. They put out a recent report which was very positive. That, for the people who are unfamiliar with it, it makes the face masks for people who've got sleep apnea. And it's been around for a long time. It is an Australian company listed in the US,
which is generally big fat Americans.
Well, whoever, but it's been doing enormously well. It's got all the fundamentals that I like, but it's not got a dividend, so you wouldn't be buying it for the dividend. But you were dead right, though, Kim. I mean, these stocks that are hinged on to the US, like CSL, Computershare, and ResMed, even Ansell, which have got US exposure, they're going to be great beneficiaries from the strengthening US dollar, the weakening Australian dollar, as they translate their US dollars into more Australian dollars as their profits improve. So, yeah, look, if you've got ResMed, certainly hold on to it. I think it's a very good stock.
Simon, are you looking at this one? I mean, have you got it in the portfolio, or is there something else that you favour in that sort of general health services area?
We don't have it. I mean, I do like the fact that it's got US dollar exposure, ageing population, getting more sick over time. This is a growth market. The ways we're playing that same thematic at the moment are more through companies like CSL, also an American, heavily American business, and Sonic Healthcare, which is more your medical testing.
And what about, again, the issue that you have whenever you look at any of these stocks, and ResMed is the same, Hef, is the PE multiples are just astronomical. Does it concern you at all?
High PEs don't necessarily faze me, as long as their growth prospects are still very strong, because that's what high PEs mean. They mean people are paying a lot more for quality. As I said, it's like comparing the Holden to a Rolls Royce. You pay more for it. But you must watch them. If they do have a high PE and the growth rate suddenly goes down, like it happened with Cochlear, in fact.
Well, exactly.
It had a high PE. Suddenly it had a profit. I don't know that it was a downgrade, but it was a reduction compared to what it was, and it got hit very hard. So you've got to watch it. So with ResMed, though, I think its growth prospects are still very strong, which can support a high PE ratio. I'm not sure exactly what it is. I don't think it's up over 30, for example. I think it might be around about 20, the 20s.
25, 26.
Yeah, well, something like that. Well, you can put up with that as long as the growth is there, and at the moment, the growth is there. And I'll just add this finally, with these stocks. I have my selling discipline. If the thing falls 15% from whatever its recent high point was, then have a look at whether you're going to stick with it, and that could be your fallback position for something that does have a high PE ratio.
Okay. All right, we'll move on to our next caller, who's Alenko from Sydney. Welcome to the program, Alenko.
Hi, good evening, guys.
Good evening.
Thanks for taking my call.
Happy to.
There are two parts of my question, but I appreciate your thoughts, if you have the time, on both of them. The first being on Telstra. I bought Telstra through the T3 offer, and I bought it at, say, probably at a cost of $3.60 a share. I've done reasonably well holding on to it, Now, what would be your recommendation as to whether I should be selling it at this point or holding on to it? Or if I have to hold it, then what would be the price I should be selling it? The second part of my question is, I'm actually in the process of building a small portfolio, planning to build a portfolio for my daughters through regular savings. And what would be the 3 stocks that you gents would be recommending me to start with?
All right. Well, let's deal with the second part first. 3 stocks in a portfolio. One of those would have to be Telstra, wouldn't it?
It would.
It would be. So
Yes.
if you had to pick 3 stocks, Telstra, what would the other 2? A bank,
I'd pick CBA, yeah.
CBA or ANZ,
Well, look, any
Either
of
or.
the 4 I think are
Either
okay,
or.
but CBA I'd put at the top.
and your third one?
I think CSL, we've just been talking about it.
Okay.
All blue chip
Well,
shares, 2 good dividend ones and 1 for a bit of growth in the US.
Your three, Simon.
I wouldn't go Telstra. I don't think there's much growth in that one,
Okay,
for
so
your
what
daughter.
are your 3?
I'd be thinking I'd back you on ANZ. I think that's a great little bank, and unlike the other Aussie banks, they've got growth in Asia, so I think that can really go
Yep.
somewhere.
And the other 2?
BHP, I think looks quite good long term, and another one that's a bit tougher, maybe Cochlear or something like Blackmores.
Okay, well that gets the tail end of the conversation out of the way. So now to come back to the important bit about Telstra. Alenko's bought it at $3.60. It's trading at $5. He wants to know when to sell or what to do with it. I mean, for my money, I think it's still going higher. What are where are you looking if you ever get to that point that we push that button that says sell?
Yeah, right. Okay.
What price have you got on Telstra for a sell?
Well, look, we're not there yet. I would disagree with Simon. I think Telstra does have growth, in fact. Now, with Telstra, if you bought it at a cheap price, there's a temptation to take some profits if it's gone up a lot. And I talk to clients about it who have got it, and they ask this specific question. What I say is, look, it's up to you. You can take some profits if you like. You never go broke taking a profit.
Correct.
But on the other hand, there's another saying...
You've got to reinvest it too.
You do, and what I say is don't chop yourself off at the kneecaps, and I've said this before. I can recall when Telstra was $4.20, and a lot of these other commentators out there said, oh, it's gone up a lot, you better sell it, take some profit. I disagreed then. Here we are, up at $5 now. So you've got to be careful about you making your own decision about where you think it's at the top, when in fact it's still going up. Let your profits run, is what I say. And I said some time ago, last year, I think it was, Kim, you might recall there.
Of course, we've got a photographic memory of every conversation with you here.
When we're talking about Telstra, and I said, when it was about $4.50 or something, I said, look, put a circle around $5 because it'll still be paying 5.6% fully franked dividend at $5. We've put the circle around it. It's now at $5. What do you do? Well, what I tell my clients is, if it gets to $5.60, it's still 5% fully franked, which is as good as the banks. And if you agree with me that Telstra still has growth potential in it, you would still be buying it. So I think it's a great stock. I'd put it in the gentleman's portfolio because I think. It's the giant of the telecommunications area, and it's getting customers from all over the place, and it's got the great coverage. It's into 4G more so than anybody else is. Not that I understand a lot about the Gs, but it's in it, and it's doing.
You know about the MCG.
It's MCG and the GGs, yes, indeed. This is a 4G. No, but it is very good, I think, Telstra. So I wouldn't knock it back at all.
We have to go back a long way to when we had T1, which was at what, $7.
T1?
T1.
$3.30.
No, it wasn't the first.
$1.95 plus you had to pay another $3.30.
$3.30, wasn't there?
$1.30, sorry.
I thought there was one at $7.
Oh, there was. There was a second one at
$7 or something.
$7, and then I think there was another one at got down to I don't know.
Well, the question I'm trying to pose to you is, when do you will Telstra in living memory ever get back to those highs that we did see of $7 and $7.50? Is that possible?
You can never say never with this stuff, and if telecommunications, if Telstra has got their foot on the innovation panel, they can do it. I mean, years ago you'd say, well, where are the banks going to go? You got passbooks and you got home mortgages. Well, now they're in wealth management and a whole lot of other things as well. So you cannot underestimate what Telstra can get into. They're in with Foxtel. They've got the football streaming onto the mobile phones. If they're an innovative, good company, they can keep growing, and I think that's what Telstra's got going for it.
Well, it's interesting you make that point about growth because we just had that Singtel Optus result out today where EBITDA was only up 1%, but what they were talking about is that they're reducing costs to maintain their EBITDA ratings, but revenue was actually down 4.6% and net profit was down 7.5%. So it does sort of play partly to the theme that Simon was talking about, is that at the big end there is some difficulty in achieving headline growth.
Yeah, but I think Telstra are ahead of Optus, so they're ahead of the pack. That's why I think they've got real good growth.
Okay. All right, we're going to take a short break, but we'll be back to answer more of your questions in just a moment. But if you would like to speak with our expert panel, do call us on 1300 30 34 35 or email us at yourmoney@skynews.com.au. Welcome back to Your Money, Your Call. Joining me on the panel tonight is Michael Heffernan from Lonsec and Simon Gazowski from Bereford's Financial. If you have a question you'd like answered by them, please do give us a call on 1300 30 34 35 or email us at yourmoney@skynews.com.au. Our first caller after the break is Bob from Sydney. Welcome to the program, Bob.
Yeah, thanks, gentlemen. Thanks for taking my call. Michael, I've heard you in the past say that you have a rule whereby you sell a stock when it has dropped 15%. Now, I don't know whether you put stop losses on that or what the situation is, but why 15% in particular? And I struggle with stop losses and just wonder where to set them. So I just wonder if you can inform me on that, please.
Actually, good question there relating to trading strategy. Is it 15%? I mean, do you set an arbitrary high for the stock once it reaches that and then do a 15% retracement from there, or how does it work?
Get back to the original point, why 15%? Why 15%? Well, it's not 20 and it's not 10. It's just a figure, which I think is a reasonable figure. Look, it's a rule, Bob, that doesn't work every time, but as I explained to clients, it works more often than it doesn't. And when you see stocks that do drop 15% from whatever the high point was, if it drops 15% from that, you look at it. Doesn't mean you must sell it. And I talk to clients and talk to them about it and say, well, what would you like to do? Would you like to put it into something else that you believe will do better? And this is what I've talked to clients about. And in many cases, they decide to change. Like last year, they would change out of BHP and put it into Telstra. That was a good move. So there's no fixed thing about it. It's not a magic pudding that will work every single time. But I've found through experience that when a stock drops 15% from whatever its high point was, it tends to drop more. Like we've had a downgrade, like Coca-Cola last week put out a disappointing.
Look at UGL today.
And UGL today, they're down, and sometimes they could drop the next day or so by 15%. Then you could look at it and say, well, what do you want to do there? What I've found is that, as I said, more often than not, when they drop 15, they'll drop 20, drop 25. And then if you've sold at 15, put it into something else. If the thing that you sold out of starts to turn around and move up again, hopefully so will the thing that you bought start moving up as well. So you haven't lost anything. And then you can go and buy it back if things look better, like BHP does now. So now you could look at BHP. So that's the way it is. It's a bit flexible, Bob. It's not a fixed thing. There's no magic formula about it. It's just one of these things that I've found over time, it works more often than not in your favour.
Simon, any comments on trading strategy, stop losses? Do you use them? And if so, how do you implement them?
I'd have to say I really don't like stop losses. I think it makes sense to me to stop, have a look if it falls 15%. But I think if you've chosen the company, if you've got the right company in the first place, if it's 15% cheaper, maybe you should be buying more. If it drops 30%, maybe that's the time to get in and buy some more. So it's not something I'm really a big fan of.
Yeah. Can I just add on? Yeah. It's not a fixed stop loss.
No, it's an arbitrary rule.
Yeah, I call it a selling discipline, not a stop loss. Yeah.
All right, our next call is from Sydney. Sydney is Michael. Welcome to the program, Michael.
Yes, good evening, gentlemen. Thanks for taking my call. I've been retired 2.5 years, and I bought a portfolio of stocks. I've got 19 stocks in my portfolio at the moment, which are all top 1 and 200 stocks, listed stocks, and I understand that the lower and mid-cap stocks have been laggards in this bull market, which we're coming into at the moment. And I was just wondering about what might be the best way to get some money into this area, like perhaps as a basket rather than individual stocks. Like, I don't know whether iShares have it, or what's the best, and probably, what's your opinion first off about that strategy? And two, what would be the best way to access it?
Right, so I might take your response to this, because you spend more time trawling through the through these stocks than either Hef or I do. Is there, first of all, that junior mid-cap industrial sector going to play catch up? If so, how long before it does play catch up? And what are the criteria that you're looking at to sort the good from the bad? And is in fact the third part of it is in fact a basket you can buy of these stocks, because a lot of them are relatively liquid.
Yeah. So I'll start with the last question first. There is a basket you can buy. There is an iShare for small cap stocks, so have a look at that.
How many stocks in it?
I think there's 200-ish. I think it's roughly 200 stocks. So it's reasonably diversified, but the important thing with iShares is you never buy them on the close or open. You might get a bad price. Buy it during the middle of the day. Small cap stocks are certainly an exciting part of the market. I mean, that's where you can really find businesses that can grow very significantly, and it's also where you find businesses that can really fall off a cliff. So a few things I'd say are key. Understand they are higher risk. Liquidity can be a big risk, so you might have a business that does really well, but because it's less liquid, like say with my netphone, you just need a few big sellers and that share price will come down anyway. You also really need to keep diversified, because these things do move around a lot. Buy a lot of them, I'd say. Most fund managers will hold 60. As a smaller investor, you can't do that, but definitely don't hold just a few. I think the last thing as well would be to make sure you're buying cash flow positive businesses, especially when you're starting out. Buy real businesses paying dividends that can grow over time.
So what do you Bob's looking at these stocks. I mean, he can buy iShares, but where would he go to get his research for, to actually find the stocks? What's the most useful source of information that you use as a professional?
For me, I like good stockbrokers. If you've got a stockbroker in that industry, they can give you good research and they can talk you through the risks. I think that's probably the best way of doing it, but I know a number of companies research the small cap market. You've got Wise Owl, Motley Fool, Morningstar. They can give you a few pointers on where to look.
Anything to add before we go to a break, Hef?
I think there's a lot of excellent stocks in the small cap area, and that's between number 100 and 300, I might say. That's the ASX classification of small stocks. And a lot of them have done very well in the last year. There's not that they've been laggard, and they've got good fundamentals that I like. You say Flight Centre, I've mentioned this before, Arb Corporation, Super Retail Group, The Reject Shop, Macmillan Shakespeare, all the internet stock, car sales, realestate.com. There are quite a number of mid-cap small stocks that have done enormously well this year, and it's Michael, is it? Who's the caller?
Yes.
I think there are a lot of good mid-cap small stocks that are still very good on the market. I prefer direct investments rather than getting some managed product. You can talk to a broker who can give you the research that you want, and I think in my view, that's the best way to go for clients, to talk directly with the broker, to give them the research, put them into the right sort of stocks.
Okay. All right, thanks for that, Hef. We'll be back with more after this short break. If you'd like to speak with our expert panel, please call us on 1300 30 30 40 34 35 or email us at yourmoney@skynews.com.au. Welcome back to Your Money, Your Call. If there's a question you'd like answered, please call us on 1300 30 34 35 or email us at yourmoney@skynews.com.au. Our first caller back is Paul from the Central Coast. Welcome to the program, Paul.
Thank you for taking my call, Kim.
Happy to.
Kim, a couple of months ago I purchased Webjet shares. Just now, the last couple of days, they've declined somewhat.
Yes.
Just wondering if it's time to sell and or hold, Kim.
Well, you probably bought those off the back of Hef's recommendation.
Yes, I did, Kim.
You did. Because see, people do follow you, Hef.
Yeah, I don't think Webjet was in my...
Yes, it was. It was.
Oh, all right.
And by looking at that chart,
yes,
which we just had up a minute ago, it has dropped the requisite 15%.
Yes.
So, what would you say that Paul should do?
You'd have a look at it, yeah, but no, in all seriousness, Webjet may have been some time ago, but the three key ones was realestate.com, carsales.com and Seek. It used to be What If, but What If has fallen off as well. So Webjet may be some years ago, but not in recent times. But yes, with that chart, it looks like it could be close to the 15%. I don't think it'll be quite at it yet. So you've got to watch it a bit more. Sometimes they do drop down and come back up again. But once they go through it, you wait a couple of days. If it looks like going further, move on.
Have you seen anything about the fundamentals at all of the stock? There's anything there that's caught your eye?
Look, they're not as good as the other ones. So that's the way I said I can't recall because they don't come up on my preferred radar screen. So they obviously don't fit into one of my categories. So,
have you seen anything on it, Simon?
Yeah, I have. I mean, I'd argue a little bit. I'd say this is probably one of the better companies in that space.
Why?
Point taken. A lot of people go on there. Not sure about you guys. They might just check the price and.
There's no ageism here, is there? Well, Hef's still wondering why he still gets the seat down the back of the plane next to the toilets.
Well, I choose it actually.
Look, the thing is, right, I've spoken to guys about this exact issue. 97% of people actually do that, and that's always been the case. But the thing is, despite that, this business has grown year after year after year, even through the whole GFC. I think it's much better value than other players in this space, and they've got some good growth options ahead. So it used to be just flights.
What about this pullback in the price? Does that worry you at all?
No, it doesn't. It doesn't.
Would you say it's a buying opportunity, or if you were holding the stock, what would you be doing at the moment?
If I was holding it, I'd stick with it.
Yeah.
But I like a bargain, so I'd probably wait for it to fall a bit more before I bought any.
Well, in this case, he's got it, and he doesn't want it to fall any further. So should he?
We hold it in our portfolios. We hold it for our clients.
Yeah.
We're not selling any of it. I still think this business can grow quite a bit because it's not just flights now. When you go in there, you can book your whole holiday. You can get a car lined up. You can line up your hotel. The whole deal.
But there are a few other competitors coming into the field as well.
Right. So you've got Expedia, probably the main competitor. The thing is, if you log on there, sure they don't charge anything. But you can only get a couple of airlines on there. You've got like Qantas and Virgin, and that's it.
Webjet offers a bigger
Webjet has
scope.
a whole suite.
Okay. All right, interesting. Well, we'll keep a watch on that one and see where it goes. Our next call is Rachel from Melbourne. Welcome to the program, Rachel.
Thank you very much, and thanks for taking my call. I've got some money coming off term deposit. I have a self-managed super fund, and I've got a lot of shares to pay dividends like banks and Woolworths and so forth.
Right, Rachel, you're breaking up there a bit. Hello?
Hello, can you hear me?
Hello?
Can you hear me?
Yeah, we can just hear you, but you are breaking up. It might be an idea if you call back in, if you wouldn't mind. But in the meantime, we'll go to our first viewer email for the evening, and it comes from Matt. Matt's asking, he would like to know whether the panel believes that the current price of around $8 in IOOF represents a good opportunity to take profits. Also, would the panel recommend buying Seek and Ramsay Healthcare despite their high price to earnings multiples? Okay, IOOF at these prices, is it a good buy or not?
I think it is. Yes, I do like IOOF. I like the shares now that are hinged onto the share market's performance. And here I'm talking about ASX, AMP, and also IOOF. I think it's one of the few smaller players in that wealth management area. It's got the fundamentals that I like. I keep talking about fundamentals. I'm talking about PE ratios not too high, return on equity strong growth, not much debt. They're the four key criteria I look at, and IOOF generally meets most of those criteria quite well. and also, as I said, it's in the right space. So I think certainly IWF. I wouldn't consider selling it. It's just like, when things go up, you say, I'll sell it because I'll take some profit. You can look at it that way, or you can look at it from the point of view, I don't want to chop myself off at the kneecaps. So you've got two different competing interests there. I tend to let my profits run. That's a saying that I prefer.
Simon, Seek's been an interesting one because we've seen that run, and this has been on Hess preferred stock list. We've seen that run up to about $11.30, and it's come all the way back to $10 in the last week or so. What are your thoughts on buying Seek at these levels? Because to me, it looks like it's probably a good buy, simply on the basis of the Chinese float of Zafan, which is later in the year. Thoughts?
Yeah, look, they are a good emerging market story, and I think they've got good growth prospects. With the market where it is, so the market's had a really good run. Seek's had a really good run. I wouldn't buy in too heavily here. I would be happy to buy a little bit, but I'd also be tempted to see if you can get it a bit cheaper down the track.
Okay. And Ramsay Healthcare, we've talked about the high price earnings multiple there. That stock just keeps on going from strength to strength, up at $34. I mean, you just you buy it with your eyes closed, don't you?
Well, I think it's a very good stock, and it's a hospital company. Look, in Australia, the government's got no option but to keep the private hospitals going. They're needed, so that's good in Australia. But Ramsay's also got hospitals in other areas around the world. I think it's in France and a couple of other countries
UK as well.
And UK, and I think it's doing quite well. It just seems to know how to run the hospitals well. So I'd be sticking with Ramsay. They're a very good operator.
Okay. All right, it's time for a quick break. Before that, though, it's time to start the stock watch. Hef, what are you watching? And your time starts right now.
Okay, what I'm watching is the first Australian listed legal services company, and that's Slater and Gordon. And people are probably familiar with it, but again, it's got the sort of fundamentals that I like, and it's also now expanded into the UK. Recently had a capital raising to give it the funds to buy these ones in England. It's got first mover advantage over there. It's got all the credentials, as I said, that I like. And I would say if you want a legal services stock, which is a good...
Welcome back to the program. If you just joined us, Michael's stock watch was Slater and Gordon, and the chart is up on the screen. Rather a fantastic run in that thing from $2 late last year to up around $2.80 now, and looks like it's consolidating at these sorts of levels. What sort of a price target in mind on that one?
I don't have price targets, Kim. I like good stocks that have got very good growth. I don't try and put a number on it and then say, well, if it gets here, then I sell it. Like some brokers do. If it goes up, they say sell. It goes down, they say buy. Which is the opposite to my theory. So if Slaters have got good growth for the reasons that I indicated before about first mover advantage in the UK, doing well here in Australia, just go with it. And that's the way to go. No specific target price.
Okay. All right, Rachel, if you would like to call in again, Rachel, that is Rachel from Melbourne, and we'll try and take your call and answer your question. But please do ring in, and anyone else out there that would like the panel to answer their expert questions, or their questions at the very least, please do call us on 1300 30 34 35 or email us at yourmoney@skynews.com.au. Our next call is Janet from Brisbane. Welcome to the program, Janet.
Hi, how are you?
Very well. What can we do for you?
I've had Campbell Brothers, which is now ALQ for quite a long time,
Yep.
and it just seems to be dropping and dropping and dropping, and I don't really understand why. I look at the company reviews and that, and they all say everything's getting better.
Okay, all right. And you'd like to know what to do with it, of course. So
Exactly, whether to bail out or stay in for the ride.
okay, all right. Well, we'll see what our esteemed, knowledgeable gentleman can do on this one. Campbell Brothers, ALQ. Mining services.
Well, it is. It does the
all the testing.
Yeah, all the testing, diagnostic testing for minerals. It used to be a favourite of mine. Has fallen off the tree. It did breach the 15% rule, as you can see, and I think I did call a few clients actually when that did happen. And asked them what they wanted to do with it, and I think quite a number of them sold it. As I said, not everybody does. It was a good move to do. But now it's also got the macro forces acting on it, which is the resources sector are in a retrogression phase, if you like, as far as capital expenditure is concerned, particularly with exploration companies, and that's what the diagnostic of Campbell's can do.
Yep.
So with that being in the decline, I think Campbell's Brothers is one that I would I'd look elsewhere with, frankly.
Well, it's actually, if we can get the chart back up, I don't know whether we can, but it looked like it was interesting because it seems to be basing out around that $9 mark there. Simon, any thoughts on it?
I think this is a space that we have to be careful of right now. If commodities do keep coming off, and there's a lot of talk of that happening, you know, these kind of mining services businesses are a bit like the tail getting wagged by the dog. Exploration will cut back a lot more than, say, mining profits, and on that basis I'd be inclined to actually sell out of something like this at these levels.
All right, well, there's your advice. Janet, if you're still holding Campbell Brothers, or the ALQ as it's now known, our experts say sell. I'm not so sure, but there we go. That's what makes a market. Okay.
It does. Every day there's
every
buyers
day,
and sellers.
every day, of course, because you know, when a stock like that comes down to around these sorts of prices, where it doesn't look like it's trading on expensive multiples, there is an opportunity.
Oh, yeah,
all right,
there is.
Our next call is Stephen from the Gold Coast. Welcome to the program, Stephen.
Yes, thank you. Look, I just wanted to ask you guys about Mirabella Nickel. I was in it a little while ago and bailed out with a stop loss, and it seems extremely unloved and still travelling south. It had a bit of a jump last week, but I'm thinking that maybe it's time to have a punt. In the minerals sector at some point. It's got to regain some ground. I'm just wondering, what the panel thinks, whether it's still got further south to go, or it's probably towards the bottom.
Interesting question, because this deal goes to the heart of the very issue with these junior explorers, and that's the malaise that they're all currently suffering. And for every chart like Mirabella, there's probably 20 or 30 stocks that are trading in similar patterns. The spec market is pretty much dead in the water at the moment. For my money, it's probably not worth chasing these unless you've got a fairly high risk tolerance. But Simon, any thoughts on Mirabella and that sector generally?
I think Mirabella's certainly had its fair share of problems for some time now. I'd only be putting money into something like this, and I'm very happy to lose. I think if it's going from 60 cents to 15 cents, there's a good reason for that. And it is not just an unloved sector now, but I can't see anything changing to make it suddenly a loved sector. So I don't think you're going to get that trigger for it to re-rate. So for me, too risky and too little chance of it bouncing back.
If you'd probably rather back more Joyce at the in his next run at Rose Hill, would you, than put money in Mirabella?
Joyfully. No, I wouldn't actually. Look, with 2,000 stocks on the market, why would you necessarily want to go and buy Mirabella? With the decline that's been going on in commodity prices, why would you do it? What my theory would be, look, if Mirabella does plateau out and then starts moving up because things have improved, there's plenty of time to buy it back. You don't have to go and do it now unless you're a bottom fisher and you've got a high tolerance to risk.
Well, the interest. Let's just flip this around and have a look at the top end of the resources sector, because it's been interesting, because we've had these presentations from both Rio and BHP over the weekend talking about their strategies to deal with capex, and what we at Kimber Capital are suggesting to investors who've had a belly full of bank shares and are becoming a little bit nervous about valuations, which you say is not an issue, but we disagree with you.
Very good. Yeah, you're allowed to.
We're suggesting a gentle program that you do take some profits out of the bank. So, like if CBA gets to $75, and you reinvest. You don't take all your profits out of the bank, but some profits, and then you reinvest a little bit into BHP and Rio for that long-term price appreciation, because in our view both BHP and Rio are trading at a substantial discount to their NPVs. Now we're taking the view here, of course, that China's not going to hell in a handbasket, and the commodity prices for the foreseeable future, while they're off, will stabilise. I'd like to get your considered input on that idea.
Thank you very much, Kim. Yeah, I wouldn't necessarily disagree with one part of the idea, and that is looking very carefully at buying BHP. Not necessarily selling the banks. You have other things in your portfolio you can sell if you haven't got the money to go and buy BHP. Look, I think there's been a sea change in BHP. I think with the new boss that they've got there now, he's focusing on clawing back the capital expenditure, focusing on productivity, focusing on cost cutting, focusing on his knitting, and that really appeals to me, rather than the grandiose plans about coal shale in America, potash in Canada. That's in the past. I think BHP is now worth a serious look at. I haven't been a fan of it for the last 12 months, as you know, Kim, but I would certainly be looking very carefully at it now. I think its future, given the way that it's being run, it seems to be very attractive to me. I wouldn't necessarily be selling the banks, but I would be getting some money from somewhere to have a look at putting it into BHP.
Anything to add, Simon?
I'd say BHP and Rio, great value here. And there's some real prospects now that those yields and those stocks are going to become quite high in the next couple of years. Do I think it'll be a quick buck? Probably not. It'll take time for those businesses to get appreciated by the market again. Look, I certainly think there's very good value in those businesses now.
Okay. All right, and if you'd like to read our report on BHP and Rio, go to the Kimber Capital website tomorrow, and that report will be up there tomorrow afternoon. The website address is www.kimbercapital.com. It's time for us to take another quick break, but if you have a question you'd like answered, please do give us a call on 1300 30 34 35 or email us at yourmoney@skynews.com.au. Welcome back to the program. We're going into our last segment for tonight, so if you've got a question you'd like answered, please call us on 1300 30 34 35. We'll get that out one more time, or email us at yourmoney@skynews.com.au. Rachel from Melbourne is back on the line. Welcome to the program again, Rachel.
Thank you very much. I hope this is a bit clearer now.
It is.
I have I have some money coming off term deposit.
Yep.
I have a self-managed super fund, and within that I've got BHP and the banks and Telstra and so forth. But term deposit isn't paying a lot, and I prefer to put something back in the share market. And I was wondering if you could give any recommendations about dividend shares, and including somebody said something's going to be happening with Optus, and I was just wondering if you could give me some advice.
Okay, well, she's coming off term deposits, looking for dividend paying stocks. So what would be your best three, say, your top three dividend paying stock picks, Hef?
Before I answer that explicitly, Kim, Rachel has said that she already has BHP, the banks and Telstra. Well, it'd be interesting to know what a total portfolio is and how much she wants to invest, because really, Rachel, when you look at the market and you're looking for dividend stocks, the top ones are the banks, Telstra, Wesfarmers, Woolworths. 7 blue chip shares.
You forgot one.
Pardon?
You forgot one.
If you got one?
No, you forgot one. Woodside.
Oh, yeah, well, Woodside's coming up a bit. Yeah, Woodside's all right. Also, ASX is another one that you can look at. But any of those are very good. But we'd have to look at what your portfolio composition was,
correct.
of course, Rachel, before we'd say go and do them. But really, my view is they're the best dividend stocks on the market for safety and growth and dividend.
Simon, your thoughts on some dividend-paying stocks?
I could put a few more into the mix to consider. I think Metcash right here has got an outstanding dividend yield. Now, that may not grow, but if you just want dividends right now, I think that's spitting out about, what, 9% gross. Other options would be Coca-Cola, really good stable business there. It's disappointed recently, so it's cheap. And I think long-term, they're going to beer, and I think that could work really well for them over the next few years.
Okay. All right, we're going to try and squeeze in our last caller for the evening, which is Doug from Cairns. Welcome to the program, Doug.
Taking my call. Kim, I bought into United Group Limited, UGL, about in the last 6 months for $11 each. Could you think that it's time to get rid of them if I can?
Okay, UGL had that earnings downgrade today. It's been a perennial underperformer at these sorts of prices. Would you sell it, Hef, or would you hang on to it? I think it's probably done its worst work and is possibly going to, in the medium term, recover from here. I don't know.
Well, if you
it's a hard one.
Sorry.
It's a hard one.
Well, if you had been applying my 15% rule, you probably would have sold it about $1 higher.
Yeah, I know. Well,
so I'd move on, frankly.
Well,
I think better things around. You don't have to stick with these things.
Yeah, well, it's a sell. Okay, so if you come out
sell and move on to something better.
Simon, your thoughts on UGL?
I don't know where they stand right now, but I think a really important thing to think about is what would you do with your money right now if you're just putting it freshly into the market? I wouldn't worry about what you paid for them. If there's a better opportunity somewhere else, and I suspect there probably is, then I'd move out of this and go somewhere else.
Those dividend-paying stocks, so exactly. If there's any of those that Doug could have a look at. But I mean, it's the problem is that Doug, bought at $11. He's ridden it all the way down to $8 odd. So I guess
Well, it's only a 30% fall. I mean, after the GFC, the banks went down 50%.
True. So take your money and run.
I think so, yeah.
Okay. All right. That's about all we have for today. So thanks very much to our guests Michael Heffernan from Lonsec and Simon Gazowski from Bereford's Financial. And to you, all our viewers, thanks very much for your calls and emails. Until next time, I'm Kim Slater from Kimber Capital. Have a great night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional.